Steve McKnight, author of the new book, From Zero to Financial Freedom, How to Do It Today. So Steve, what have you been up to since your previous book?
Well, lots happened since writing the last book. And what have I been up to? I've been up to lots of interesting things. I've been up to setting up a managed fund for Australian investors to buy US commercial property. I've also been working diligently at PropertyInvesting.com, which is the website which is my vehicle principally to educate people. And I've been contemplating, if I was to lose all my money and have to start again from scratch today, exactly what I would do and what I would do differently in today's property market compared to when I got started over 10 years ago. And the answer is lots and radically different, because house prices have gone up. And because house prices have gone up, the amount of the deposit that you need in dollars has also gone up. And also the amount of the loan that you need to take in order to buy the investment property has gone up too. And that has meant the old mantra which I used to talk about, which was buying your way to financial freedom, one positive cash flow property at a time. If you adopt that approach today, you'll run out of money before you're financially free with positive cash flow. And so we now need to do things differently.
So how many properties do you have now?
Well, Mia, it's a tricky thing. Do we count properties as, if I own a mobile home park with 100 properties in it, is it one property or is it 100 properties? I prefer to count them as income producing dwellings, and I would own 250, 300 income producing dwellings at the moment.
Is that over time? I hear you purchase property on a weekly basis.
Well, the average over the last 13 years is I've bought or sold a property every 6.25 days, so one a week for 13 years, which is quite a number.
It's quite a number.
You need a pretty powerful system in order to be able to not only buy, manage, but ultimately sell a property portfolio. But unlike most people, I believe you own a piece of real estate until you can do something better with the money. And so I've constantly looked to buy real estate, to hold it while it makes money, and then when I can do something better elsewhere, to dispose of it and redeploy.
All the properties you own in Australia?
Surprisingly, no. Of recent times, I've bought a large property portfolio in the United States of America because, again, I saw a unique opportunity while the Australian dollar was high and US house prices were low to buy positive cash flow properties on ridiculous returns, 25, 30%, etc. But those days, much like what happened here in Australia, as the US economy's picked up and house prices have recovered, returns have gone down. And so as returns have gone down, we have to ask ourselves the critical question again, where can I make the most money with the least risk in the quickest time for the lowest aggravation? And as investors, that's what we need to concentrate on. Where can we get maximum bang for our buck?
So do you still recommend the US to investors, or is it quite risky?
Well, all investors need to try and invest in markets that they can understand and invest in markets where they can find problems, fix them, and then sell them as a solution to make money, or rent them as a solution to make money, as the case may be.
So what do you recommend to your investors? To look at the best country or the best suburb to invest in?
Oh, that's a good question. Investors should really be looking at where is the inefficiency. And so long as people live in houses, you can make money out of real estate. I find that people tend to focus too much on location, where there are good properties in this suburb, but there aren't good properties in that suburb. There are two types of inefficiencies that I recommend that people focus on. First one is a property inefficiency. The second one is a buyer inefficiency. A property inefficiency is something effectively wrong with the dwelling. And it could be something simple, such as the house is obsolete. It was built in the 50s, but now it has a higher and better use. The land could have a better house on it, and it would be more as a package, or it could be subdivided or something else. The second type of inefficiency is a buyer inefficiency, which is hopefully selling the property that you own to another buyer on some kind of terms that create a cash flow outcome. And if you take the mindset that you're an investor, you have two ways that you can make money. You can make money generically, which means it's market driven, or you can make money via manufactured means, which your skill and expertise as an investor drives the outcome. So if you're a generic investor, you want to buy assets that go up in value or provide cash flow over time. The problem is you're not in control of it. If you're a manufactured investor, you're using your skill and expertise to solve property or buyer inefficiencies. And that's where it's at for me. That's where the rubber meets the road. The question everyone needs to ask themselves is, are they a passive or active investor? If you're a passive investor, you need to go down the generic profit route. If you're an active investor, you can go down the manufactured profit route.
So Steve, earlier you spoke about the economy in Australia and internationally changing. So how has that affected your strategies to invest?
Yeah, well, in a nutshell, the original strategy was to buy cheap houses en masse, and the incremental positive cash flow from owning all these positively geared properties would eventually surpass the amount of money you earn in your job. You'd be financially free, high five, skip off down the road, never have to work again. Well, with house prices going up, the amount of property that one person could buy, you weren't buying $44,000 houses in Ballarat anymore. House prices went up to $100,000, $200,000, $300,000. And so if you were going and buying positive cash flow property, well then that was great, but you ran out of money before you got to that magic financial freedom goal. And so instead of trying to buy your way to financial freedom, we had to interpose a new step, which was build up your capital base, part one, and then redeploy out of growth into income for part two to be financially free. And that's the story of the book, how people apply this new model in today's property market to go from zero to financial freedom.
And do you see this market getting better or worse for investors?
Well, look, the property market will get better and it'll get worse because it ebbs and flows. But what investors need to do all the time is to interact with it so that they can find the great opportunities in down markets and the easy opportunities in good markets. Unfortunately, investors lack the skill to be able to do that. So what they tend to do is look for the lazy, easy profit, the indolent profit, as I call it. But as we know, if you try and reap where you haven't sown, it won't work. And no one in real estate can make a consistent profit being lazy. The best opportunities will be acquired by the best investors. And so if people want to be a better investor, they ought to improve their investing skill. I make this point in the book. No one can get an external outcome without first having an internal outcome. And practically that means that the real asset in a property transaction is the investor and the investor's skill, his or her ability, and the application of that ability is the property. Unfortunately, people put their faith and trust in the property rather than their own skill, and so they're not in control of the driver of their financial future.
So what do you see as the fundamentals that stay true even during a financial crisis?
Well, let's look at the housing market. You've got people that own houses as their homes, and you've got people who buy houses for other people to live in. It's reasonable to expect that dynamic is going to continue. So you're going to have the owners and we're going to have the renters. If we look at the rental market, we then say, well, as investors, are we going to supply that rental market? Or as investors, are we going to supply that home market? What product are we going to supply? And if you want to supply the home product, that's great. Look for the inefficiencies in the buyer or the property. And if you want to supply the tenant market, well then look for the best rental return that you can possibly get. So the basics of property investing, the game of Monopoly if you like, are going to stay the same. But the nature of the opportunity will change depending on what else is happening out there in the economy.
So Steve, if you were going to go from zero to financial freedom in today's market, how would you go about it?
All right, in a nutshell, here's what I'd do. First of all, I'd work on creating what I call an income accelerator. So something that brings in money other than my job, because sooner or later my job's not going to be able to allow me to have enough money to buy a multi-property portfolio. So I need to supplement my income. That's part number one. Part number two is then I'm going to look to build my capital base as quickly as possible. How much capital base do I need? Well, that depends on what income return I want per annum and what rate of return I can achieve. And then the third thing is, once I've got my critical asset base, I'm going to redeploy it in the highest possible income return I can get. So let's look at that really simply. Let's say that I wanted $100,000 a year of income and I could get an 8% return. Well, that means I need $1.25 million of assets invested at 8% to have $100,000 per annum. So if I'm starting from zero, the question I ask myself is, how do I go from zero to $1.25 million in the bank as quickly as possible? And then once I've got my $1.25 million, how do I redeploy that in an asset giving me a net 8% return and I'm financially free? And that is the essential question which the book will take you through and then help you chart the pathway that's best for you.
Now, your book, From Zero to Financial Freedom, How to Do It Today, what inspired you for the title?
The inspiration came from the members at PropertyInvesting.com who consistently asked me, Steve, I'm following this idea of buying positive cash flow property, but I'm finding I'm running out of money before I'm financially free. Help. What am I doing wrong? And I said, well, you're not necessarily doing anything wrong. You're applying old technology to a new market. And, new wine for new wineskins. At the end of the day, you have to have a relevant strategy for a relevant market. And I wanted to give people a system which, instead of being time sensitive, became something that they could use no matter what happens to the property market, which is what this new two-part system does.
So how does this differ from your previous bestsellers?
Well, originally the thought process was to buy as many incrementally positive cash flow properties as you could. Now we're saying that approach won't work because property prices have gone up. Instead, what you want to do is you want to buy properties that are going to grow your capital base, and then once you've got your critical mass, to then go and buy income producing assets rather than buying those income producing assets first.
Now, I noticed that you recommend certain types of investors focus on, say, other businesses and the share market as well before they actually invest in property. So this actually sounds quite controversial from someone who's known as the most popular property investing author. Why do you say this to your clients?
Real estate has made me a lot of money, but it's not the only way to make money. And different people have different lifestyle needs. And what I want people to do is to connect with the best way for them to be able to make as much money as possible. Within the system that I recommend, real estate is one facet of it. The other facets of it are having this income acceleration. And this income acceleration, of which I think there are three types, is vitally important, particularly for people who want to move away from their job. The first type of income accelerator is an offline business. So a typical business, but many people have the wrong kind of offline business because you want a business that throws off cash, not a business which is multiplying to an end value. You can then have an online business, which is my personal favourite, which is trading ideas for income via the internet. And the third option is share trading, if you have the right psychology to be able to handle it. I don't. But if you do, then good luck to you. But what you do is you use one of those three or more, two or three of those income accelerators to build your income as soon as possible, to take that income and then to go and buy property with it to build your capital base.
Can you tell us more about these income accelerators? What are they?
Well, I used to be an accountant, and I quickly realised that I was being employed to solve people's problems, but that required for me to swap my time for money. And I realised that sooner or later, that was a game I wasn't going to win at. I was going to run out of time before I had my money that I wanted. And so what I thought was that instead of swapping time for money, let's break the system and let's start swapping money for time. Well, how do you swap money for time? You have to have money to start off with. And if you don't want to work harder in your job because you're swapping more time and there's less time for your investing, what do you do? And so I coined this phrase, income accelerator. And I tried to find ways that people could use leverage other than time to earn money. So with an offline business, you leverage employees' time. And with an online business, you're leveraging the internet, which is a store that can be open without having any staff in it. You have the computer as your staff. And then there's share trading, which is leveraging off the stock market. So if we can find some form of leverage other than your time, then you can open up new opportunities to make money.
So we've got an online business, we've invested in the share market, and we're ready to move into the real estate market. Where do we go to from here?
Someone has to start by asking how much time do they have between now and when they're going to be financially free. And depending on their answer, that'll push them in one of three pathways that I talk about in the book. Then people need to work out how much, or whether they want to be passive or active, and then how much money they've got available. And depending on the answer to those three questions, the right investment strategy will drop out down the bottom.
And do you think finding that pathway is dependent on, how much money you have, or your personality, or how much time you want to actually put into it?
Oh, definitely, all of the above. One thing I would say is the road to financial freedom is littered with failures. People who thought it was going to be easier, people who thought that they were going to get a quick return, people who bought courses that promised riches that didn't eventuate. Being financially free is incredibly difficult. That said, to me, there's no other choice, because with 2/3 of couples retiring broke, needing the government for assistance, and 3/4 of singles retiring broke, the present system of working a lifetime isn't working. And on that basis, something different has to happen. The question is, what? What's the credible alternative? And the only credible alternative I can speak from first-hand experience from is the credible alternative that has allowed me to become financially free, which is the basis for From Zero to Financial Freedom, how to do it today. If you want to keep working in your job and retire broke, it's not the book for you. If you want to be someone who believes that their destiny is going to take them somewhere better and brighter, then this could just be the key that unlocks that gate to that better and brighter financial future that people are looking for. It's worked for me, and I believe it can work for others too.
So it really is a practical guide to investing. What would you say is the number one insight that you love to give people when it comes to investing?
Well, I believe people know they want something better, and they're sitting there scratching their head saying, how? Tell me how. I just don't know. And this book is a how book. It's not a book that talks to you about what your life is going to be like when you're financially free, because that's whatever you want it to be. But it's a book that will say, here is the path. It's not an easy path to walk, but it's a path that if you walk it faithfully and if you walk it consistently, that the financial outcome that you will derive will be better than the other road, which will lead you down to the current statistics of 3/4 or 2/3 of people ending up retired and on a government pension to sustain their life. Who wants that?
Now, how can we get our hands on this book?
Well, if you're old school and you like the print version, you can pick it up from bookstores, no worries at all. You can buy it from PropertyInvesting.com and we'll ship it out to you. Alternatively, if you're into some new technologies and you wanted to get an ebook version, it is significantly cheaper, and you can buy it from Amazon or iTunes and stores such as that, and get it straight to your electronic device and start reading at your leisure. The book is really designed to be accessible. It's not a large book, Mia. It's only 15,000 words. It is designed to be motivating, but more so it's designed to fill in the blanks and give people a system they can use, a pathway if you like, to achieve financial freedom. It's not necessarily going to answer every question you've ever wondered about property investing and creating wealth through real estate, but it will lead you to the right path, and it will explain to you how you can go from zero to financial freedom today, hence the name of the book.
Now, before we go, and I know you get this question a lot, but how do we find positive cash flow properties in today's market?
Look, positive cash flow properties exist, and the lower interest rates go, the more properties are positive cash flow, because the number one expense for investors is interest. The problem is that interest rates will eventually go back up again, and those properties that were positive cash flow will become negative cash flow. But the answer to your question, Mia, in a nutshell, is to apply my 1% rule to find positive cash flow properties, which works like this. Decide what interest rate you can borrow at, say 6%, add a percent to it, 7%, and then that becomes the minimum return on investment that the property has to earn in order for it to be positive cash flow, on the basis of borrowing 80% of the purchase price. If you had a property, rent 10,000, purchase price 100,000, 10% return, 1% rule, 7%, will be positive cash flow. So it's a question of crunching the numbers. But any property could be potentially positive cash flow depending on the debt level against it. And indeed, the system that I advocate in From Zero to Financial Freedom, how to do it today, is to own property debt free. So it would be positive cash flow anyway. But you know, that question is almost redundant now, because the system isn't about buying positive cash flow property from day one. The system is about building your asset base now and then redeploying into debt-free commercial property. So the conversation I'd rather have with people today is, Steve, how can I build my capital base as quickly as possible? Rather than, Steve, tell me, where do I find positive cash flow properties? It'll be interesting to see if, having read this book, the sophistication and the level of sophistication of investors and the questions they ask is improved. I very much hope so.
Thanks so much, Steve.
You're welcome, Mia.
Steve's new book is available as an ebook and as a paperback in your local stores.